Welcome back to the podcast. I'm Barry Schwartz and joined as always, Ernest Wong, head of research at Baskin. We're coming to you mid-September. Kids are back at school.
Yep.
The weather is still beautiful in Toronto. The stock market, it's September. So I got to address this, Ernest, because everybody's been talking and sharing charts. The returns on the S&P 500 in the month of September have generally been negative. And I thought that was all baloney, right? Who cares what month it is, what day it is? But if you, there's a chart going around that shows the S&P 500 returns, and 57% of the time, September has been a negative month. The good news is that October, November, December have generally been positive months. And of course, we've talked about it before, 75% of the time in a calendar year, the S&P 500 tends to be positive. Your take on the seasonal effect and any rationale as to why September usually is a lousy month for markets?
So I don't think so. There are certain seasonal phenomenons in the stock market which at least have a plausible explanation for why they occur. Mm-hmm. So, for example, if the stock market dips in the last 2 weeks of December, I think that's plausible because people are wanting to realize tax losses before the calendar year ends. Mm-hmm. I don't think there's any explanation to why September is an abnormally performing month. Yeah. Is there?
I don't know if there's any expectation.
Like, is it because people are coming back on vacation or whatever?
No idea. I couldn't tell you. It's one of those months, and maybe the algorithms react to it and know it's going to be more volatile. I haven't read anything to give me any rationale as to why September is more negative than any other month.
No, so let's play this out.
Okay,
So,
all right.
Suppose one of the things that people like to say about these kind of phenomenons is that it becomes self-fulfilling if enough people start to believe it.
Yeah.
But then the problem with that is then it becomes arbitraged away over time.
It should be.
Because people will start anticipating that the market's going to correct in September, and they'll start selling in August, and then people would start buying September. Yeah. And so you just can't make a predictable rule out of something like this. Yeah. And that's why I don't pay attention to it.
Exactly. And that's why we here at Baskin Wealth Management don't pay attention to it. And if anything, welcome pullbacks in the market. Clients will hopefully give us new money all the time, their savings, their earnings, possibly new prospects. And so we need to put cash to work. And we don't always want to be buying every stock in our portfolio at 52-week highs and all-time highs. We need opportunities to rebalance our portfolio, find cheaper stocks. And so, if September turns out to be a bad month, maybe it's an opportunity for us to switch out of a more expensive name into a name that may have better returns. Maybe you'll see that in your portfolio. Maybe you'll see us do some rebalancing. Don't know, but we welcome volatility. If it was boring and it went up every day, then
that would be good.
It would be great, but I don't think there would be the rewards in the market. There's a product you can buy that goes up every single day. It's called a GIC. Yes. It's called money market. There's no volatility to it. And of course, on an after-tax fee inflation basis, it may be a completely unrewarding investment. So with volatility comes opportunities. Yeah. So I wanted to touch on a topic about long-term investing, and we talk about long-term investing. What the heck does that mean? How do you guys prove that you're long-term investors? And I shared a tweet the other day of a number of companies in our portfolio that our clients own and that I own personally that we've held for many years, some of them going back even 2 decades, that have been multi-baggers in our portfolio. A multi-bagger, in our opinion, is a stock that's gone up more than 2 times since we bought it. And we have a number of stocks in the portfolio where I see clients that have owned it that have gone up 10 times or 12 times or 15 times. And so it's pretty remarkable, Ernest, that we have a list of 17 companies that clients still own today, that we're still buying for new clients when attractive, in our portfolio that have gone up a tremendous amount. And that's I think the key to long-term investing. If you think about, we've owned Apple for clients since 2012, and a lot of crazy stuff that has happened over the last 12, 13 years. We've held it through thick and thin. Our process is really to trim back names once they get too big into a portfolio, because we don't want one or two stocks dominating the portfolio. Sometimes that's a good move, sometimes that's a bad move, but that's our process. We're here to protect and preserve our clients' wealth. So you can see that tweet, and we'll link it to the show notes, the stocks that we're talking about. I'll list some of them now. Apple, Alphabet, Brookfield, Moody's, Microsoft, Visa, Constellation Software, Costco, First Service, Waste Connections. Just a few names in our portfolio that have been held a very long period of time. Your comment on what I just said?
Well, it's certainly, I think it's certainly comforting to know that at least some of the names in our portfolio are working the way that we hoped that they would.
Mm-hmm.
I think there's been a lot of questions on your tweet about why our reported returns on our website don't match the returns from these stocks.
Mm-hmm.
And there's three reasons why. The first is that the portfolios that we report on our website include fixed income.
Yes.
And so when a client joins Baskin Wealth Management, they get an asset allocation that is appropriate to their own personal circumstances. And that often has a material fixed income component, which is obviously earning returns that are below what stocks would earn.
Yes. When we publish our results on our website, they may include a cash or fixed income drag. As well, they may include a client brought in position into the portfolio. So, we're not running a hedge fund or a fund here where it's dollars to dollars versus the S&P 500 or the TSX. So that's your first point. You have a few other.
Yeah. The second point is that we have a material component of Canadian stocks in the portfolio, of which it's simply it's not relevant to compare Canadian stocks with the performance of the S&P 500.
100%.
They're Canadian companies.
Yeah, and those that may take a look at our returns and say, how come you're not beating the S&P 500 in this year, that year, or whatever? That's not relevant to us because our portfolios we're not 100% U.S. investments.
And lastly is that we are not perfect investors. Some of the names that we've picked have not worked as well as we hoped.
Exactly.
So,
and as I mentioned before, we trim positions. We position size, whether rightly or wrongly, and that's because our mandate, our goal is to preserve our clients' wealth, and we're looking to protect portfolios from volatility. We've owned Apple for 14 years. We've had 12, I've had some clients that have gone up 12, 13 times their cost base, and we've trimmed it. I don't think we have one client who has never sold Apple. And that was the right decision for us, for the comfort level of our clients. Also, I think one other point is we report all our results in Canadian dollars.
Yes.
Net of fees. The S&P 500 doesn't have fees. I get it. But I've yet to see one person who has owned the S&P 500 exclusively for the last 25 years without making any trades or getting scared out when the market goes down. But anyway, I'm not here to get into that argument.
One thing that I would say about the names, some of the names that, as I look down the list, is these were already recognized as good businesses when we bought them.
Yeah.
It's not like we knew anything about Apple that no one else knew when we were buying the stock.
Yeah.
Same with Constellation Software. I think everybody, when we bought the stock, it was already widely recognized that Mark Leonard was a capital allocation genius.
Yeah.
I think what we have done probably a little bit better than some other investors is really trusting the management of the business to run the company in an intelligent way and to find creative ways to continue to grow the business.
That's right. So, these are all growth companies. When we bought Apple, it was really just the beginning of them launching the iPhone. when we, when we bought Brookfield, we had no idea it was going to spin off all these assets and create all these, different partnerships and grow their business tremendously. It was a much different business. Same with Microsoft. We had no idea there was going to be cloud computing in 2013 when we bought the stock. How could anybody know these things? So it's all about growth, all about letting these businesses mature, get into different markets, and allocate that capital so efficiently.
And one other thing that I think we have done particularly well, to just brag a little bit, is that I think we understand the businesses pretty well, which allows us to hold on when things are not good. Because business doesn't go in a straight line. Things happen, sometimes bad things happen to the companies. Sometimes the stock falls, and sometimes you get there's a lot of reasons to be scared about certain companies
For sure.
at any point in time. And I think having conviction that the business is a good business and that the management's going to do the right thing, that allows you to hold the stock when things are not going as well as they could be.
There's no perfect investment when it comes to equities. You have to trust that you're owning a good business, that you understand the business, that it's going to overcome maybe some short-term problems and focus on growth. And that's really what we want to own. We want to own companies that can play in gigantic big markets. And when I look at the names on our list of what I call multi-baggers, many of them still have very small market shares in very big markets, or looking to get into other big markets or adjacent markets. And I think what a lot of them have in common is playing in big markets, pricing power, distribution, awesome management, great free cash flow and smart allocation of that free cash flow, and reinvesting it to get more growth. So, the list of 16 or 17 companies that I shared, I hope 10 years from now we still own a majority of them. I don't think Apple will compound at 35% a year for the next 10 or 12 years. But we still believe it will deliver terrific results for our clients going forward. And that's the thought process there. So Ernest, our feature discussion is about one of these companies, a multi-bagger in our portfolio. I think, Ernest, we started buying Brookfield. I don't know what the original name is now, but was it called Baskin? And then I think they changed the name to Brookfield Asset Management. David Baskin and I started buying it for clients around 2004. If I look at some clients who've held it since then, tremendous returns. And this doesn't even include, Ernest, all the spin-offs that our clients have received. Many of our clients also own or still own Brookfield Infrastructure Partners, which compounded. I think it spun off in 2008, 2009. That compounded tremendously. As well as other special dividends and other investments. So Bruce Flatt and his team have, delivered exceptional results for our clients, and just had its investor day. And our feature discussion is, can Brookfield continue to deliver? It set some high expectations in that investor day, as it always does. And so, Ernest, take it away.
So for those who are not as familiar with the Brookfield empire, I think it can be a little bit confusing because there's a lot of different Brookfield companies that exist. So at the very, very top is what we call Brookfield Corporation. That's the mothership. That's the entity that controls everything. Apart from Brookfield Corporation is Brookfield Asset Management. And this is the asset management business, which basically manages money for other people, kind of like Baskin Wealth Management, and they earn fees for managing money. And Brookfield Corp owns 73% of Brookfield Asset Management. So both of these entities held their investor day. And then beyond Brookfield Corp and Brookfield Asset Management are what Brookfield calls the listed affiliates. So these are Brookfield Infrastructure Partners, Brookfield Business Partners, Brookfield Renewable. Is there one more?
Brookfield Business, Infrastructure, Renewable, and the reinsurance? Or is that a separate?
The insurance is is weird. I don't really want to get into
Okay.
that today.
So
But-
there's a few Brookfields out there.
And these are basically public funds that are managed by Brookfield Asset Management. And Brookfield Corp also owns a stake in the listed affiliates as well. And so you can see how this structure is kind of circular to some extent. And that's why some people don't like the complexity of the structure.
No, some people will look at it on a quick basis and say, I don't understand it. The valuation, I think it's trading at 80 times earnings. I don't get it. It looks like a plate of spaghetti to me. Looks like they're moving money from one to the other. It's confusing. There's been a famous Canadian analyst company that has always had a sell target on the stock. They've been completely wrong, and they don't trust the accounting. But there are reasons to believe that Brookfield is doing everything correct, lots of reasons that it's doing everything correctly and set up as a proper corporation. And I think everything that Brookfield and its management does is to unlock shareholder value. Why? Because the management team are the largest holders of the stock. They're in bed with you.
No, and that was something that was pointed out today.
Yeah.
Because, you can say, well, Brookfield has shady accounting. They're taking money from one pocket and putting it in another.
Yeah.
But the CEO, like Bruce Flatt, and his team continue to buy stock, and they own a lot of stock.
Yeah.
There was a slide in the Investor Day that makes up like over 90% of their personal wealth, and they themselves as a group own 20% of the stock.
Yeah.
So,
and that's no joke. This is a stock that what is Brookfield's market capitalization? $80 billion, like Canadian.
it's a lot of money.
That's a lot of money. So Bruce Flatt has a billion reasons.
Yes.
And as well as lots of his other partners for the stock to do very well going forward.
So, but the key difference between Brookfield Corporation and Brookfield Asset Management is that Brookfield Corporation has capital in the business. They actually manage their own money. It's kind of like Berkshire Hathaway.
Yeah.
Warren Buffett's investing the money that Berkshire has in buying Apple and, Occidental Petroleum and railroads and See's Candies and all those things.
So Brookfield is kind of like the puppets.
Yeah.
The puppet master, sorry.
Yes.
The rest are all puppets, so to speak.
Kind of.
Okay.
Brookfield Corporation manages its own money. Brookfield Corporation manages its own money, and Brookfield Asset Management manages other people's money.
Correct.
Some of which belongs to Brookfield Corporation. That's the main difference between the two businesses. And the capital allocation priorities reflect that. Because Brookfield Corporation has money to invest, capital to invest, their strategy and priority is to grow that capital, like compound that capital. Whereas Brookfield Asset Management is an asset-light business because they're just earning fees for managing other people's money. They just pay most of their earnings out as a dividend. And generally, these asset-light recurring revenue type businesses, such as Brookfield Asset Management, are valued at a premium in the stock market because of their stable cash flows and dividend yields.
Yeah, it's a great business. Brookfield Asset Management, the management of all these private and public funds is a terrific business. As you said, very asset light and generates an enormous amount of free cash flow.
And recognizing that the market likes these kind of businesses is why Brookfield Asset Management was separated in the first place, which was, I think, two years ago.
I think it was December 2022.
Yeah. So about 2 years ago.
Yeah.
And this is where we are today. Brookfield does an investor day basically every year. So I think the goal is less about learning something new about Brookfield that you didn't already know, but kind of looking at what are some of the near-term priorities and how are they thinking about things in the near term.
Okay, so what is Brookfield Corporation thinking now? How have they pivoted their business now that Ernest inflation is coming down? It's maybe not as low as people would want. Now that interest rates have come down in Canada and will probably be coming down in the U.S. And as well, we're facing huge demand for AI and all other the electrification of the grid. How is Brookfield pivoting itself or preparing for those opportunities?
So that would more belong to the asset management slide, or asset management arm, because they are going to raise funds to take advantage of those trends that you mentioned.
Yeah.
So, for example, they have they launched a fund called the Global Transition Fund, and that is just a kind of a catch-all product to invest in products that are transitioning the economy to net zero. And this differs from renewables because renewables is specifically solar and wind, right? But then the transition fund allows them to invest in things like nuclear, things like natural gas infrastructure, right? And I think one thing that's important to keep in mind as you're flipping through Brookfield's slides is that they're an asset manager. Their goal is to sell investment products.
That's right.
And so
they need to create new products and sell those products, right? So it's a self-serving, but for good reason. And if they do well, they charge a nice management fee as well as a performance fee. So they want to launch new funds and benefit from big trends.
Yes. And so as any good asset manager would do, they stay on top of trends. They launch new products to gain investment dollars into them. And as you pointed out, like obviously the performance has to be there.
Yes.
But I
think that's why there's Brookfield gets a little bit of hate, or they say they're so promotional or too marketing, or Bruce Flatt is too slick. But he's put the puck in the nets, right? Not only with the performance of the stock, the Brookfield Corporation, as well as the results of the business. The fundamentals have grown. So you can hate him. You can think that the company's too promotional and that can turn you off, but the results speak for themselves.
No, and lastly, if you're an investor in an asset management business, that's exactly what you want.
Yeah.
It's somebody who can smooth talk people into investing in your funds.
For sure.
Because that's what an asset management firm does.
Yeah. Well, you don't get to manage. What are they managing? $500 billion or?
So they're managing asset management.
Yeah.
Today is managing $500 billion in fee-bearing capital.
Yeah.
And $1 trillion if you include the debt behind that.
Okay.
So, because it's a private equity firm, most of their investments that they're buying involve a lot of debt. And they're not charging fees on that, obviously.
No.
So Brookfield's ambition
my point, just to cut you off, is you don't get to manage $500 billion if you stink.
Yes.
Okay, go ahead. Yeah.
And in their investor day, I think they just wanted to make the numbers round. They want assets under management and fee-bearing capital to double. So in 5 years, they think they're going to do $1 trillion in fee-bearing capital and $2 trillion in AUM. And where's that growth going to come from? So the growth is pretty much for asset management. It's going to come across the portfolio. It's going to come from things like private credit, which they've been investing a lot in through Oaktree. It's going to come from transition, like global transition. I think last podcast we mentioned Bruce Flatt's comment on electrification of the grid and the enormous amounts of power that's going to be required.
So let's just break it down quickly. So private credit, Ernest, is lending money to private businesses or even public companies instead of them going to the banks.
Yes, this is historically more associated with private equity.
Yeah.
So if there is a private equity firm that wants to buy a company or an apartment building or whatever, then they will go to a private credit provider and they'll get a loan. Instead of the alternative would be to go into the bond market or to go to a bank.
Yeah. This would be a cheaper option, and you can roll up a number of these loans into a fund and charge fees on it. Obviously, you don't get the same type of returns as you do from equity, but not everybody's looking for equity-like returns. They're looking for higher returns from fixed income. And with bond yields now starting to go down in Canada and the U.S., there could be good reason why private credit could be a growing area for Brookfield.
Well, private credit is generally a more expensive form of financing, but it's very customized because the lender, in this case Brookfield, or an Oaktree, they know exactly, they're very familiar with what you're doing. They're carefully underwriting the loan to meet their specifications. Whereas if you go out into the bond market, it's, you're very bucketed into what that is, and you need the investment bank to go out and find like investors and all that stuff. So those are the main areas of focus for asset management.
And with all these funds, Ernest, Brookfield will try to source deals as well as reach out to its network of clients.
Yep.
So we're launching this new fund. Our last fund for you has done great. So this is the power of distribution, something that's few people talk about, but it's a real competitive advantage that Brookfield, as well as KKR and Blackstone, all have. They've delivered. They're strong. They have a strong marketing team, a strong deals team, and that resonates with, let's say, you're the Canadian Pension Plan. You're probably not going to do a private credit deal with Barry and Ernest's new private credit fund,
Right.
but you're probably going to take comfort in seeding or giving funds to Brookfield to manage.
Right.
Okay.
So that's Brookfield Asset Management. They think the business is going to do well and pay dividends, which go into Brookfield Corporation.
Yeah.
And so for Brookfield Corporation, the primary focus of the presentation was capital allocation, as expected, because they have capital. And they put out this slide that talks about their estimated value per share. I think there's a lot of snickering about kind of where they get this value and what it represents.
Don't ask the barber for a haircut, so to speak, right?
Yeah. But
yeah, I mean, if someone knocked on my door and asked me what I'm worth, of course I'm going to tell them a very high number.
yeah. But basically, they said they think that the stock is going to be worth, or the value of their assets is going to be worth $176
a share US.
US.
The Brookfield stock today, Ernest, is trading in the mid 40s.
Yeah, $46.
46 US. They believe in 5 years that the value of Brookfield Corporation is $175, $176. That also includes what they see as the carried interest, these performance fees that haven't come and hit Brookfield's balance sheet because those funds are still operating. But once those funds are in their vintage, so to speak, then they'll be collecting higher fees. Whether or not the market will ever value that or not is another story. But if those things deliver, that is true cash that comes into Brookfield Asset Management and then up to Brookfield Corporation, correct?
That's right.
Yeah.
So there's three sources of growth for like how they get from $84, which is the current estimate of value per share.
So Brookfield is saying today that it believes its stock, Brookfield Corporation, is worth 84 US.
Yes.
The market says, no, your stock is worth 45, 46 US. So how do they get to the 84?
Right.
Yeah.
So I think this is an important topic because a lot of investors like there's a big debate about what Brookfield's net asset value actually should be.
Yeah.
Is it $84? Is it closer to 46? And I actually don't think it matters that much because at the end of the day, like what matters is whether they're growing the underlying business. Is whether whether or not there's a discount to the in the public markets. Like it matters a little bit.
Yes.
Because of capital allocation and all those kinds of things. But at the end of the day, it's about whether the assets inside Brookfield are growing.
Yeah.
It's whether they're investing money and that's growing.
Agreed. Right? And we don't know if it will get to 84 US or 176 US in 5 years. But if Brookfield allocates capital correctly, launches more funds, makes good buys of operating businesses, as you said, allocates capital maybe with more buybacks, that some gap will close and the stock should do well from here.
That's right.
As in the past.
So there are three sources of growth for how they get to the 176. Number one is, as you noted, the carried interest.
Yeah.
Because Brookfield Corporation actually gets most of the carried interest that is earned on Brookfield Asset Management's funds.
Yeah.
And this is a pretty meaningful amount of cash flow that's coming in over the next few years.
So from the date of inception to the date of the split,
Yes.
which was December 2022, Brookfield Asset Management, it's not a new company. It was running a number of funds, maybe not $500 billion of fee-bearing capital, maybe $300 billion, whatever, 400, whatever the number was. When those funds finally generate performance fees, each fund has different structures, but at some point those performance fees will be collected by Brookfield and Asset Management, and they all belong to the corp.
The legacy ones.
The legacy ones. Going forward, any assets that Brookfield Asset Management, any new funds that it starts, that it launches, that gets performance fees, it will go directly to Brookfield Asset Management. But Brookfield Corp,
2/3.
2/3, yeah. And still, but Brookfield owns 73%. It's all weird, but the bottom line is, if the funds deliver, shareholders are going to do well.
That's right.
Yeah.
So that's number one. Number two is what they call wealth solutions. And this is essentially not really a wealth business, but an insurance business where they write annuities, like annuities are basically like GICs,
Yep.
where they pay 5% for perpetuity.
Yeah, annuities are extremely popular in the U.S., less so in Canada. Part of your portfolio, you may have a portion of your portfolio that has a guaranteed income stream. You've given up that capital forever, and you're going to get income paid back to you for the rest of your life.
So Brookfield writes annuities, and they use that money from selling the annuity to invest themselves.
Yeah.
And they earn about a 2% spread on that by investing in things like high yield bonds, private credit, and real estate.
Yeah, it's an insurance product. Ernest, I'm going to guarantee that you're going to get 5% for life. You give me $1 million, I'll give you 5% for life. I'm going to take that $1 million. I think I can invest it better than you, and hopefully I'll earn 7 or 8%, and everything is gravy. Has there been any screw ups with that? Has Brookfield delivered on growth and wealth solutions?
Well, it's a very new business, a very new initiative for them.
Not a new business overall. It's a new business for Brookfield. Lots of its competitors are in this
Annuities are not a new thing.
Correct.
But Brookfield just got into this game. I think at the end of the day, it really comes down to how well do you trust them, that their private, their fixed income operation, right? How much do you trust that they're going to make good investments on that side and not blow up?
Yeah.
That's really the question. And Oaktree is probably the best high yield shop in the world, I would say. So I think they're going to do pretty well on this.
Okay. And they've recently acquired an insurance company to help increase distribution, correct?
Yes.
So the goal, how much are they doing in this business right now?
Very little.
Very little, but they're planning it to be a multi-billion-dollar business.
Yes, and the reason for that is because a lot of the annuities that they wrote today are not invested yet. I think it takes time for them to begin to deploy them and earn spreads. And once they do that, it's a material portion of earnings for them, which also benefits Brookfield Asset Management because they're going to be managing and earning fees on that insurance float.
Correct. Interesting. Okay, so a good chunk of that annuity business is going to be invested in Brookfield Asset Management funds.
Yes.
Excellent.
And so the last question that I think has probably been the main drag on Brookfield stock is their real estate business, because there's a lot of office properties inside this business. And as you know, office is not doing very well right now.
Prior to 2020, when we were all going to the office every day, Brookfield had a very nice real estate business and owned some of the key trophy office real estate around North America. Canary Wharf, just like terrific office buildings. San Francisco, as well, it owns a significant stake in shopping malls.
And they doubled down on it.
Yeah.
By taking Brookfield Property Group private.
Yes.
At what they considered to be an attractive price at that point. I think there's a few things to say about this business is that, number one, Brookfield is good. Okay. Brookfield segments their real estate into two buckets essentially. There's a core business, which is trophy assets that they want to own forever. And there is what they call a transitional bucket, which is basically
Crap.
Yes.
Yeah.
Low quality real estate that they don't really want.
Yeah, it's kind of like it's a little bit interesting. It's kind of like me saying, well, here's the multi-baggers in our portfolio.
Yes.
And then the rest, and here's those other ones that don't count and don't look at them just because they haven't become multi-baggers yet. But the bottom line for Brookfield is they think they can create value with those non-trophy assets.
So the hope essentially, what they said in the investor day is that because interest rates are falling and because capital markets are opening up again, they hope they can sell some of this stuff.
Yeah.
Right?
Yeah.
Which is not a lot, by the way. It's about $7 billion. So not nothing, but it's also not crippling.
There was a worry at some point, Ernest, that we'd have like a complete commercial real estate collapse and Brookfield would be on the hook. And that's what's going to hurt its value and it's going to be in big trouble. But I think they've structured those commercial real estate assets properly, where if they have to hand back the keys to an office building in San Francisco, it hurts, but it's not crippling to the business.
No, and I think the more important point is that the fundamentals of the portfolio, the core portfolio especially, are actually doing quite well.
Yeah.
Even for office. These are very high quality office towers in places like New York or Dubai or in like Tokyo, right? And these are not like the occupancy for these are 99%. Rents are still going up.
Yeah. If you're going to the office 3 days a week, you still need to have an office, whether or not it's whether or not it's 5 or 3 days, you still have to pay the rent, and rents have been going higher, I think, for those trophy assets.
Yep. Yeah. And so I think there's a decent case to be made that these are actually worth close to what they say they are. Because if you look at the valuations that Brookfield is holding them at, I don't think they're completely out of whack to what reported figures from other third-party sources are.
And so Flatt and company have tried to signal to investors that they're undervalued in a number of ways. I think Flatt has purchased shares of both Brookfield and Brookfield Corporation a year ago when the shares were lower than they are today, showing his commitment to the company. I think Brookfield has purchased or bought back $1 billion of stock already in 2024, showing its commitment to try and narrow the gap. I think they're very committed to narrowing this gap between that plan value and a market value. But as you said, this is a growth company. What matters for Brookfield is to continue to get growth, and the stock should follow.
Yes, and I think the third component of growth is obviously their stake in Brookfield Asset Management, which if they meet their goals on fundraising, then should continue to do well.
And so the latest news that we saw that out of the investor day, and it's a little bit confusing, is Brookfield Asset Management, because it had such a big stake of the companies owned by Brookfield Corporation, it's a very illiquid stock. And they're looking at ways to unwind or at least add some liquidity to the stock, and if that happens, maybe there'll be more institutional investors, and maybe Brookfield Asset Management would get a better valuation, which would once again narrow that gap between the market value and plan value.
So we get a lot of questions about which one do we prefer, Brookfield Corporation or Brookfield Asset Management, and we own both for clients, depending a bit on the strategy and the risk preference of the clients.
Keep in mind that we were shareholders of Brookfield Corporation, and they spun off Brookfield Asset Management. So we didn't get to decide whether we wanted it or not. I think the way the allocation worked, as you said, 70 to 73% went to the Corp and a small stub to Brookfield Asset Management.
So the original spinoff was 25%.
Yeah.
They've issued, Brookfield Asset Management has issued some stock over the years.
And so, okay.
And so today it's about 73%.
So they've been diluted a little bit. But the dividends have gone up from Brookfield Asset Management. Yes. So it's probably a wash.
And we prefer Brookfield Corp, essentially. And the reason for that is because we like compounding. And Brookfield Corporation is the one that, well, first of all, you capture the value of growth that comes from Brookfield Asset Management. But more importantly is that they have a great track record of allocating capital.
Yeah.
They have a good track record of making investments, buying things when they're cheap. Well, we'll see what happens with this real estate thing. But they have a generally good track record of buying things when they're cheap and selling things when they're expensive.
Yeah.
And that's exactly what you want a company to do.
And Brookfield Corporation, the split was set up so that they could create this Brookfield Asset Management stake for those that are looking for more current income.
Yes.
But I think Brookfield Corporation itself, its dividend actually went down.
Yes.
So there's more cash flow for it to do more things, whether buying back stock, making acquisitions, what have you. And so Brookfield Corporation, you said something very interesting. You said, we like compounding.
Yeah.
Brookfield Asset Management, I think its mandate is to pay out 90 or 95% of the free cash flows as dividend. There's nothing left over to grow. The only way Brookfield Asset Management can grow is issue more shares. Whereas the power of compounding from Brookfield, where it can buy back stock, it can make acquisitions, it's not encumbered by paying out all the cash flow to the shareholders, and there's so much cash flow coming in, it should be the better performer over time. But I still think if you're looking for income, Brookfield Asset Management is probably a terrific asset for your portfolio as well.
So one thing, so that was very well said, and it's a perfect articulation of why we like Brookfield Corp.
Yeah.
One last thing is what wasn't planned for growth, which is the listed affiliates.
Yeah.
You can very clearly tell over the last 3 years that the priority for growth is not in the listed affiliates. Mm-hmm. Yes, they are still there. They're still participating in deals. They still have pools of money inside. But Brookfield Corporation does not expect most of the capital to be deployed to come from these affiliates going forward. Mm-hmm. And so to the extent that they're still going to be paying fees to Brookfield Asset Management.
Yeah.
But they don't plan to invest more money into these things.
Interesting. And some of those things are not as, their balance sheets are not as beautiful as the parent to them, Brookfield Asset Management. So do you think, is there any plan to do anything with those listed affiliates?
Well, they have a track, Brookfield has a great track record of listing these affiliates when the market likes these kind of things.
Yeah.
And then selling or buying back stock of them, or buying more stock of them personally when they're undervalued. I think they just bought some shares of Brookfield Infrastructure and Brookfield Renewables not too long ago because they thought it was undervalued.
And those are nice yield plays that have been beaten up because of rising interest rates. If you own them for the dividends and you were getting 5% on a GIC or money markets, it's less attractive now that rates are coming down. The renewable and the infrastructure businesses should maybe catch a little bit in terms of just the dividend yield being more attractive now that rates are come down.
And then obviously they took Brookfield Property Group private, so took full ownership of that. And then correspondingly, in 2021, when the market was very enthusiastic about renewable energy, Brookfield Renewable actually did a secondary offering, so sold more shares. And Brookfield Corporation itself sold a large chunk of Brookfield Renewable shares as well. So this is why we prefer the corporation, because they're able to make these decisions that are advantageous to themselves. And we expect them to keep doing that.
Did you learn anything new, Ernest, from the Investor Day before we finish off?
One thing that I thought was an interesting observation is that Brian Kingston, who is the CEO of Brookfield Property Group, the real estate business, did not present. And this is kind of interesting because I don't know if we've mentioned this before, but Bruce Flatt mentioned his successor.
Yes.
Connor Teskey, who's the current CEO of Brookfield Asset Management.
So Bruce is probably close to 60.
Yes.
At some point, he will move to the chairman role, we assume, and kind of like Buffett, and have the younger CEOs be more active running the day-to-day business, whereas Bruce would be more of the marketing person.
Yeah, exactly. So Connor Teskey is going to be the new CEO of Brookfield Corporation.
At some point in time.
Yes. And this was actually a surprising pick because Brookfield has a very deep bench of experienced leaders who have been around for a while. Connor Teskey just joined, not a couple of years ago. He's been around for a while, but relatively new to the firm. He's pretty young. I think he's like 36 or something like that. And to me, I think that this, like, I don't know what happened to Brian Kingston, but I think if you combine to the fact that Brookfield is expecting the real estate on its balance sheet to shrink over the next 5 years by quite a bit.
Yeah.
I think that this is a clear signal that that's not the emphasis of the business going forward.
Yeah.
Right. So.
And Bruce Flatt has talked a lot in his most recent letters to shareholders about the transition to an AI electrification world. That's something he's very excited about. Very little mention of real estate or infrastructure. And that will be funds that are managed by Brookfield Asset Management. So really putting all the ball into Connor Teskey's court, so to speak.
Right. So I think that's the one thing. The other thing that I think is interesting to note is that fundraising has been a little bit light this year. It's not a secret. That's why the stock has been not performed as well as it probably could have.
Is it indicative to Brookfield or across the entire industry?
I think it's a little bit. I think it's largely
Brookfield.
It's largely Brookfield. I mean, I don't follow the other alternative asset managers, so
Gotcha.
I can't really speak to them.
Gotcha.
But
sometimes you're hot, sometimes you're not.
But so in 2023, they set a target of $163 of planned value by 2028.
Yeah.
And now this year they have the target of 176, right? So that implies a 6%, ish change from 28 to 29.
Yeah.
Right? If you are comparing between presentations, and that's quite a bit less than the 16% per share value growth that they're expecting.
Yeah.
So there is like an implicit admission that things are not as rosy as they're presenting them as.
Fair enough. Well, maybe they thought by this time the real estate would be doing better, that they were launching more funds, what have you. All that being said, it's kind of a moot point to discuss whether the planned value is $176 in 2028 or 2027 when the stock is at $40 US.
Yes.
It's all ridiculous to worry about that. Let's not have that as a worry. I'm going to sell this stock because they said the planned value is only going to grow 6% from one year to the other.
In 5 years.
It's kind of silly. What's more important is you hit it on the head many times is here's what they're trying to do to grow the business. And if it works, I don't think you'll complain in 5 years. That's it.
Yeah.
Good to see you. We'll see you back here real soon.